Sound speed.
Marker.
Action.
Check, check. Check 1, 2.
Son of a...
Sound speed. Action.
Hello everyone, thank you so much for joining us for another True Audio Presents. This is a little bit different than the normal True Audio Presents that we do. Usually you see me with another manufacturer talking about the newest gear. But we're in a little bit of a different time. If you haven't noticed, we're in tax season. And I'm going to be flat out honest with all of you. This is the bane of my existence. I can't stand taxes. They scare me. I've got goosebumps doing not only this live stream, but doing a live stream about taxes. So I thought, well, if I'm a sound mixer that has this type of, negative energy around this, I don't really know what I'm doing. I don't know who I should trust and who I should go to. Well, I found an incredible team over at Robert Hall & Associates. And I have with me today Tony Watson, who is an incredible senior tax consultant and public speaker. He has a bachelor's degree in business administration from Chapman University. And he has tons of different awards. The one that I specifically want to bring up is Glendale's Reader's Choice Award for Best Tax Preparer in 2016. These guys are located in Glendale, and I want to bring them in right now. Tony, how are you doing? I want to say thank you for being here. How are you?
I'm doing very well. Thank you so much, Thomas, for having me. Very, very privileged, very honored to be here today and bringing all of this great information to the attendees today. So thanks again.
Absolutely. Well, the way that I want to start this one today, Tony, because I know that you have an incredible presentation that is here to basically help people learn about, incorporating and, what's going to be happening in the next month and two specifically. But what I want to do first is talk to you about the ideal sound mixer. And so when I say that, when we talk about a production sound mixer is somebody that works as a service entity. So he's going out and providing his services as an individual, but they also have equipment. So we deal a lot with, not only providing our services, but also renting our gear. And from there, sometimes we're renting the gear to things that we're working on, the productions that we're working on. Sometimes we're renting it to separate entities that are just out in the world, our friends and, other recommendations and whatnot. Other things that we deal a lot with is we purchase a lot of equipment. It's not a rarity for us to purchase anywhere between $30,000 to $100,000 worth of gear in a calendar year. And included in that, there is always a lot of services. We get a lot of broken gear, so we have a lot of service ticket items that we have to get repaired too. And the other thing that I want to throw on is that a lot of sound mixers, we're bad at finances, but we're really good tinkers and we love to build things. So a lot of sound mixers, they end up becoming these product inventors and they create things and then they end up starting their own companies and they don't really know what to do with it. And then when tax season comes around, they're just so overwhelmed, like me. They need someone like you to basically handle this. So that's all I'm really going to do to preface this. I'm going to hand it over to you, and I'm basically going to act as a moderator today. If you guys have any questions for Tony about your taxes, we're here today. We're here to listen to him about everything that he has to share and answer your questions. Tony, it's all yours.
Great. Thanks again, Thomas, for having me on. And we work very closely with actually contractors and independent contractors and business owners in all aspects of the entertainment industry. And many of my clients are producers, both in the music and the film industry. And we're very aware that, the equipment side of things is probably one of the main deductions that keeps professionals in this industry from paying exuberant amounts of tax. So I'm very excited to talk to you about the depreciation litigation expenses that we can really capitalize on, and some of the other great benefits of incorporating and setting up your business different ways to further reduce overall liability. So once again, thanks again, Thomas. If we want to go ahead and load up on my end here, I'm going to go ahead and share my screen and get this going here. Share screen, perfect. And do this, share. And then Thomas, you just give me a thumbs up if you can see my presentation.
Yep, we're good. Absolutely.
Perfect. All right. Excellent. So once again, my name is Tony Watson. I work with Robert Hall & Associates. We are a full-service tax consulting firm, been based out of California, Southern California since, 1971. And we have been helping thousands and thousands of self-employed individuals across the U.S., actually, even though we only have one location here in Southern California. Across the U.S., we've been assisting with tax filings for the past 50 years. So this is our 50-year anniversary. Today's topic, the power of Inc., tax savings during times of economic uncertainty, something that's very near and dear to my heart, just because I own some small businesses as well outside of my tax practice. My wife is a self-employed individual. So moving forward as a tax advisor 17 years ago, I realized something very quickly in the second year that I started working in the tax industry, is that self-employed individuals really retain the most benefit built into the Internal Revenue Code. And so whether you're in the music industry, in the film industry, in the consulting industry, contracting industry, the benefits for being self-employed are exponential. And so we really need to hone in, especially during these times of economic uncertainty, we really need to hone in on these really great aspects of the different parts of the Internal Revenue Code and how to maximize those benefits for each one of us in our own specific industries. So once again, my name is Tony Watson. I've been with Robert Hall going on 17 years. This is my 17th tax season. Time flies when you're having fun. I am also the public speaker for our firm. Very honored, very privileged to be able to bring this information to you today on behalf of Robert Hall & Associates. I also practice what I preach. I am an enrolled agent, so I file taxes in all 50 states. A majority of my clientele are small business owners and real estate investors. So a lot of my dealings with my clients, when you add all of the value of their business assets and real estate assets up, I probably manage just in my column well over 150 million in real estate and other business dealings. So I do see a lot. Same with our firm. We just have a wide range of clients that gives us a better insight into how certain industries are run from a tax perspective. And then I'm also, once again, the public speaker, keynote speaker. Last year was very unique for a number of reasons. I think we could all agree on that. We did over 140 webinars last year in 2020. And like I said, very honored, very privileged to be here today bringing this information to you, just because we had a lot of our clients who weren't doing very well in 2020. Businesses were being shut down or shut down, not permanently, but temporarily. And we just kept on going last year. We wanted to make sure that our information was out there for the general public to eat up and to digest, and make sure that moving into 2021 for the 2020 tax year, that they knew every single angle to maximize on their return, to overall pay their obligation in tax and not a penny more than their obligated amount. Remember, it's not about what you make. It's not really even about what you spend. It's about, at the end of the day, what you get to keep. And so I always equate wealth growth or growth in overall portfolio to proper tax structuring and proper tax planning. Because if you can save 10, 15, 20 grand in tax, isn't that like you making 10, 15, 20 grand more in income? It's not going to the government. It's staying in your own bank account. So keep that in mind. Tax planning is also wealth retention. That they go very much hand in hand and very, very comparable to each other. I'll mention this at the tail end again. We do offer free consultations here at Robert Hall & Associates. That's something very unique about our firm. We'll sit down and review 2 or 3 years of tax returns. If you've already prepared 2020's tax return, send it our way. Let us review it. Make sure that we check off cross the T's, dot the I's, so to speak, and make sure that there are no red flags on that return moving into the 2021 filing season.
Guys, just to let everyone know, there is something to say about that. I've done taxes, in California for a long time, obviously my whole life. When I went to Robert Hall and I worked with Minju, by the way, can you please let Minju know I will get my stuff to her as soon as possible? I'm sorry, I've been working on this live stream and not my own stuff, which is shame on me. But the thing that I love about it is that you're looking at the past taxes and you've been able to be like, hey, look, there are a couple things that maybe weren't done necessarily correctly that you've been able to help to, reverse and, get more of my money back, which is super helpful. So thank you for that.
Absolutely. And that's the number one goal here at Robert Hall, is to not only plan ahead to pay less tax, because it is the right of every taxpayer to plan ahead to pay their obligation in tax, but also for our clients to understand a little bit more, or at least to understand just enough to be dangerous, right? Dangerous in a good way. It is very much a chess game with the IRS every single year. I call that tax returns our final exams. Even though we've graduated from school or we've gotten past high school or college or grad school, there's still always this final exam that we have to file each year. And this final exam is a lot more important in my eyes than the senior thesis that we wrote before we graduated college. This is something that can determine whether or not you were able to retain most of your wealth. Number one, whether you're able to acquire large assets, purchase new inventory, purchase a home. Tax returns are the center of most of your largest financial transactions. So just be aware that tax returns are not just some form you file every year. They are incredibly important financial documents that tell a story to the banks, that tell stories to creditors, that tell stories to the IRS. So just be aware of that as you move forward into your planning timeframes. Okay. Is incorporating right for everyone? Absolutely not. I want to make sure that everybody in today's webinar understands that incorporating is not going to be right for everyone here listening today. But is it important to understand why you shouldn't be incorporated versus why you should be incorporated? Absolutely. You want to know your options. I've always been a fan of having options in life. And so when you want to protect your business separately from all of your personal assets and personal liability, incorporating is probably the first go-to conversation with any financial or legal advisor. Is incorporating right for you specifically at this moment in time? Well, that's not a yes or a no question. It's very much a maybe. And in the tax industry, I don't like answering questions with a maybe, but it truly is just a maybe. We need to sit down and dial in your year-to-date income and expense figures and find out if your profit, as well as your liability that you risk and run as a business owner, but mainly to figure out if your income is high enough to warrant the cost of being incorporated. Because at the end of the day, we know that by incorporating our businesses, we are separating our business from our personal assets, therefore creating greater asset protection. But above and beyond that, we also want to make sure that it makes financial sense. We don't want to incorporate showing huge losses through a business. And sure, that loss is great to save tax elsewhere, but it's going to cost you maybe a couple grand to file a corporate return each year. So we want to make sure that the corporation is going to save you at least $2+ grand in tax, minimum. And so that's really the main conversation that you should be having with your licensed tax advisor. What entity structures do we have to choose from? We have the S corporation, we have the LLC, we have the C corporation, we have the LLP, the LPs. What you can ignore probably 80% of those entities. We're really going to focus mainly on the LLC and the S corporation for a number of reasons. One, the LLC is great for limiting liability on large assets, which in the sound recording industry, let's face it, most of your assets outside of maybe a rental property that you own in a primary residence, the largest assets that you'll own is your equipment, right? $50, $60, $70+ a year in recording equipment is not very uncommon in your industry. In fact, just yesterday, I'm not kidding, just yesterday, my third or fourth appointment, he works in the music production business for the film industry. And I'm looking at his receipts and he purchased over 150 grand in equipment last year.
Yeah.
And you know what happened with that 150 grand? We were able to accelerate the depreciation write-off and get him to pay nothing in tax on the federal side. So I'll explain why it's just on the federal side in a second. But as you can see, when you reinvest profit back into your business, it's going to save you a lot of income tax and allow you to retain more of your wealth. Now, above and beyond you just spending money or reinvesting it back into your business, you also want to protect your business. And so the LLC is the greatest asset protection entity for equipment, like your soundboards and your microphone equipment, and I know that microphones could be thousands and thousands of dollars just in themselves. And so that LLC allows you to protect those assets separately from everything else that you own. Now, one very unique thing about the LLC is that it's great for protecting large assets, but the LLC itself does not save you any tax. Okay. The LLC strictly limits liability. If that's one thing that you take away from just the conversation of LLC S Corp, LLCs save you nothing in tax. They only limit liability. If you make an election through a tax advisor, if you make an election with the IRS for the LLC to be taxed as a different type of entity, different story. See, the greatest thing about knowing what I know and knowing what we know here at Robert Hall is that we might be able to get our cake, have our cake and actually get to eat it too. And my boss loves using that analogy because it truly is the case. If we can incorporate you as an LLC, creating great liability protection for your assets and your business, but make an election with the IRS to be taxed as an entity that will actually save you tax, why would we not do that, right? So the LLC can make an election to be taxed as an S corporation. And in this case, the S corporation out of all entity structures is in fact the only entity that can actually save you tax. I'm going to have a very detailed breakdown in the slides to come of how that works number-wise. And it's really going to allow you to see some of the major benefits that corporate America gets that other W-2 earners do not receive. And that, let's face it, this is one of the biggest reasons why people complain about the wealthy not paying tax. Well, it's because the wealthy have multiple entities. They have multiple assets. They have huge depreciation expenses. They are able to utilize the tax code to their benefit to retain most of their wealth. And it's much easier to build wealth that way when you know the power of tax planning.
Yeah,
so
they're just kind of working with the numbers.
Are different. Yeah. I'm sorry, Thomas, did you have a question?
Yeah, I was just saying, yeah, they're basically just working with the numbers and, moving and shifting things around to make it work for them in a better way.
Very much so. And remember that the wealthy of America didn't write the tax code. I truly believe that the tax code was written for the wealthy of America, but we always have to remember that it is actually our governing agencies that draw up the Internal Revenue Code. I would like to assume, and I don't like assuming very much of, these days especially, but I would assume that the people who write the Internal Revenue Code, because of how complicated it is, they're incredibly brilliant mathematicians. The way that things are calculated on a tax return and how some people will qualify for a credit, others won't. It truly is a brilliant structure, but we've all heard the phrase, it takes money to make money, right? And when you talk about taxes, yes, when you are uber wealthy, it is much easier to pay a large tax bill because even after the tax bill is paid, like the Jeff Bezoses of the world and the Donald Trumps of the world, it's much easier just to pay the tax and then move on because you're still a billionaire at the end of the day, right? But those individuals, they understand, or their accounting staff understands, their business accounting CFOs, they understand the power behind the tax planning side of the equation. So when you incorporate, yes, you get great asset protection for your business. You're separating everything from each other. So if your business is sued, they're not suing you personally. If you're sued personally, they're not coming after your business assets. But as you start to structure your business in specific ways, it creates more opportunity for you to shelter income tax, not evade paying tax. Remember, tax evasion is illegal, right? But proper tax avoidance is not. And so through planning, you are avoiding tax, not evading. Always remember that. So always plan ahead. Failing to plan is ultimately planning to fail. I could throw out phrase after phrase after phrase. I won't bore you with those. I'm done with all my phrases, actually. But you have to understand that this is truly a benefit that only the self-employed contractors of the world receive.
Tony, this is a really good point, and I want to actually ask you a question because we have a question from the audience that kind of relates to this a little bit. He says, in my first year as a sound mixer, I made around 10K. Should I have tried to purchase that much in gear? Talk about used gear purchases versus brand new. And I think that, it's not 100% like what you're talking about, but we can kind of form it into that because if I'm a sound mixer and I'm just starting out and I'm making $10,000 and I'm thinking, wow, I want to make a new purchase of this new gear, is this a time that I need to start thinking about incorporating? Should I incorporate before I make this gear purchase, or should I purchase this gear then become incorporated? Who owns the gear? Can you talk about this a little bit more? Nathan, let me know if this is going to answer your question.
Absolutely. In fact, Nathan, if you don't mind, in 2 slides, I'm going to dive more into detail about that exact topic. So I just want to talk really quickly about insurance versus entities, and then I'm going to come right back to answer that question, if that's okay.
Yeah, sure.
I don't want to get ahead of myself. I promise you, I'm going to come full circle with all of this about income thresholds and when it makes sense to spend all of your money and for deduction purposes. So I'm going to get to that. Is that okay if I just talk about one more slide and then we'll get back into that?
Let's do it.
Perfect. So let's hop on to the next slide, because I do want to, for the naysayers in the webinar, I don't think there are any naysayers, but for the individuals who say, well, Tony, I don't need an incorporated entity because I have great insurance. I have a liability insurance policy. I have a malpractice insurance policy. I have a general hazard insurance policy, workers' comp. Well, remember that insurance is there and in place to pay out a settlement in case an unforeseen event happens, right? Just the other day, I had a producer that I was doing taxes for, and we were on a FaceTime kind of conversation. His phone starts ringing in the background. He picks it up. He goes, Tony, excuse me, picks it up in the background. And I hear him talking to people who are still on set where he's producing, right? And somebody had fallen off the soundstage and broken both of their arms. And so, you have insurance in place to pay out settlements in case something like that happens, right? Because if they didn't have liability insurance, if they didn't have malpractice insurance, if they didn't have all of these insurance policies, that might be a big issue, right? So when you talk about entity structuring versus insurance, you also have to realize that these two things provide completely separate benefits. Insurance actually has a dollar value. It actually has like a paid out value that you receive at the end of the day. Whereas an entity structure does not. An entity structure really doesn't have any dollar value, but it allows you to take your business out from under your social security number and separate it under its own social security number, essentially, except it's called an FEIN, a federal employer identification number. So asset separation equals asset protection. You actually very much need both of these things. In fact, the most important thing in my mind would be insurance. Because whether you're incorporated or not, you should always be insured at some level. Health insurance, liability insurance, car insurance, traveler's insurance. I mean, you name it, there's a policy for it. There's even wedding insurance. I had to buy it for my wedding 5 years ago in case it rained, right? And all of that money went down the drain. So there's insurance for everything. Very, very important. Entity structuring allows you to separate assets. Okay, so let's talk about, and we talked about a little bit of the difference of those two, but getting back into this question, because I want to dive into more detail about what the thresholds are, why it would make sense for someone to incorporate even though they don't have a certain amount of revenue. So let's talk LLCs first and foremost. LLC stands for limited liability company. It is not a corporation. Okay, so LLCs are owned by percent, and the government allows LLCs to, I'm going to use the word manipulation, and I'm going to tell you why I don't think that's a good word, but it's the only word that I can really think of in this situation. LLCs are allowed to manipulate ownership, meaning that if the gentleman's name who had the questions, Travis?
His name is Nathan.
Sorry, Nathan. I just want to address Nathan's question specifically. Nathan, if you have a business and you don't have partners, you would be considered, if you started an LLC, you'd be considered a single member LLC. Therefore, individually speaking, under your social security number, everything is at risk that you own under that personal social, right? When you separate your assets, your sound recording equipment, maybe you have a car under your business, desks, chairs, filing cabinets, shelving units, storage units, all of these assets that you're buying personally. But you know that as your business starts to grow and you start to retain, 5, 10, 15, 20, 30 grand of income, as your income gets higher, this is a conversation that you should have with your tax advisor. Incorporating is never a bad thing. That's what I wanted to mention. Incorporating as an LLC does create great limited liability protection. But if you're only making 10 grand in income and buying 10 grand of expenses or equipment, whether it's new or used, I would not suggest for you to have an LLC. It just doesn't make sense. I'd suggest for you to have a great insurance policy, a liability insurance policy, but at 10 grand of income minus 10 grand of expenses, let me just be real frank with you, who's going to sue you for 10 grand of income? Now, if you've built up hundreds of thousands of dollars in equipment over the past 10, 15 years, and now this LLC is generating 10 grand this year, but has $150,000 of equipment, nice equipment, depreciable, but new equipment or used equipment, but in good condition, then you might want to start an LLC simply to protect your assets separately from you personally. So once again, LLCs are great for limiting liability on assets, but they're not going to save you tax. So at 10 grand of income, my suggestion would not be to incorporate for a tax benefit. I would have to dive into more detail about what you own total as far as assets are concerned, and also a little bit of a conversation as to what kind of risk and liability you operate at. For instance, if you're a sound recording artist for Red Bull, right? And you're up in a plane with these skydivers and you're holding the boom out the window and then you got the camera guy and everything else. Or let's say you're jumping out of the plane with somebody, recording them on the way down. Just a random example, but you see this all the time. Those kind of industries run a very high risk and liability. And so if you individually have assets, if you own your own home, if you have a retirement account, if you're married and your spouse has assets, these are all reasons for you to separate any high risk or liability businesses from you individually, especially if you have valuable assets. So I hope that answered a little bit of your question, but the income threshold, to be honest with you, for us to even have a conversation or entertain the idea of incorporating is not really the gross income that you bring in. It's not that 10K number that we're talking about. We need to figure out what your net profit is. Because remember that all we really care about as taxpayers is what we're going to pay tax on, right? So if I make $1 million and I spend $950,000 in equipment, right, and I only have $50,000 of profit, that's the number that I pay tax on. Now, in that situation, obviously, if you're making $1 million, yes, you more likely than not would be incorporated for a number of reasons. But just for argument's sake, let's say you're making 100 grand and you spent $90,000 on a camera. Let's say you finance the camera equipment or the microphone, the boom equipment. Let's say you just financed it. You put $2,000 down. You have a loan that bought this $95,000 microphone or recording equipment. Well, sure, you're only going to pay tax on what's left over, but it doesn't negate the fact that you made $100,000 that allowed you to buy a very valuable piece of equipment. Even though you only put $2,000 down on it, you get to accelerate the overall equipment purchase. And this is a commonly asked question in the tax industry. They say, well, am I only able to write off the $2,000 that I put down? Well, no. See, in this situation, it doesn't negate the fact that you still bought it. You just used somebody else's money to buy it, right? So you still are allowed that 90 to 95 grand expense. So your net revenue is low enough to where an incorporated entity, even an S corporation, isn't going to save you any tax because your profit is already very low. But if you're making 100 grand and you're spending $20,000 with $80,000 of profit left over, different story. So the golden number, I'm coming full circle with this, the golden number for you to incorporate for not only the asset protection benefit, but also the tax benefit is at roughly $45,000 to $50,000 in profit. Not gross income, not total income coming in, but after all of your expenses, if you're at 45 to 50 grand, you're looking for asset protection and the tax savings. If you don't have those figures, but you have many assets, then you may want to set up an LLC simply to protect those assets separately from all of your own individual personal liabilities. So I don't know if that did that answer. Hopefully, Thomas, that answered most of his question. I think I probably went a little bit overboard with my answer.
No, I think that answered a lot more people's questions too. That was a really thorough answer. I love it. Thank you.
Beautiful, beautiful. Yeah, and I did want to mention once again, when we talk about LLCs, LLC stands for, once again, limited liability company, not corporation.
Yeah, I want to apologize. I had a slide that said corporation, everyone. My slides are wrong. I took that off, so that's not right. That's my fault.
Yeah, sorry. So, but I think that I wanted to, on my old PowerPoints, I actually did throw up something that said limited liability corporation because I wanted to show people that this is what the general public thinks an LLC is. They actually think that an LLC is a corporation, when in fact, when you start an LLC, just as a little bit of a side note on some legal jargon, when you file articles with the state of California to become an LLC, you file articles of organization, not articles of incorporation. And so an LLC is owned by percent, not by share. A corporation is owned by the amount of shares. So that's why I love LLCs, though. Let's say that I have 3 business partners. We all want to open a sound recording studio. I'm the finance guy, CFO, doing all the taxes, applying for the loans. And then my other 3 partners are all the creative minds, right? And I wish I could be part of that, but I'm more of a numbers guy. So I'll stay on my side of the fence. But let's say we all group together. They know that I'm good at what I do. They know that they're good at what they do. So naturally, it's kismet, right? We're made for success because we've got all angles covered. Well, I might want to set up an LLC because if I'm the money guy and I'm bringing a lot of the capital to the table, an LLC will allow us to split profits 4 ways evenly, but an LLC will allow me to deduct all of the expenses that I use my money to purchase for the LLC. So we can allocate expenses differently, but profit evenly. So it allows you, once again, that word, I'm going to use it again. I don't like using it, but manipulation. LLCs allow you to manipulate numbers internally, whereas an S corporation does not. When you own 100% of an S corporation, you own it 100% of the shares. When you own 50% of the corporation, you own 50% of the shares, which means that 50% of the liability is yours, 50% of the assets are yours. You cannot allocate different liabilities and other expenses under an S corporation. So one main difference, and that's why LLCs are also great for partnerships. Now, if you set up an LLC for a partnership and me and my 3 partners, we start to make a lot of money. Let's say that our net revenue is hitting 50 grand, then 75 grand. Now we're up to $200,000-$300,000. When we go to talk with our tax advisor, right, the tax advisor is going to say, well, you've run out the LLC benefit, so to speak, or not run it out, but you've brought the LLC to a certain threshold to where it may make sense for you to make a special election with the IRS. Once again, it's a chess game, right? So now you're at that point where you can make a special election with the IRS to be taxed as an 1120 S corporation, still having great limited liability protection. The LLC is still in place for state legal purposes, but for tax benefit purposes, you are going to file moving forward as an S corporation. And so this is, once again, a very unique part of the Internal Revenue Code that not a lot of people understand. I'll be real honest with you. This is something that I learned probably week 2 that I worked for Bob Hall 17 years ago. And I realized very quickly, man, when you start to make more money, it really does become easier to pay less tax. Okay. And so the tax bill is meant to benefit business owners. As of 2018, under the Trump administration, that tax bill was probably the most pro-business tax reform bill ever in the history of the United States. Actually, probably second to 1962 when they introduced all of the real estate related loss deductions, which kept real estate people very wealthy and allowed them to make more money over the past 50, 60 years. But for business owners in general, starting in 2018, the Trump administration introduced a couple new things that helped business owners like yourselves, whether you like it or not. If you receive 1099 box rents or 1099 miscellaneous compensation, whether you like it or not, you're a business owner. So as of 2018, there were a lot of benefits built into the Internal Revenue Code to help you pay less tax. And we're going to get to some of those in the upcoming slides. But I wanted to make sure that everybody understood that LLCs are great for limiting liability. Subchapter S corporations are the only entities that will actually help you save tax. And here's how it breaks down. Okay, this is going to make a whole lot of sense. It's gonna lift that shade off of your eyes, and you're going to realize, wow, now I understand why people hate corporate America so much because of all of these benefits. But you also have to somewhat group yourself into corporate America, because this is not a benefit just for the billionaires of the world, not even for the millionaires of the world. This is a benefit for anyone who yields a profit under a self-employed business of at least 45 to 50 grand. That is a small business. The government doesn't see that they see that as a very small business. Small business in the IRS's eyes is anything under $10 million in gross revenue. That's considered small business at the government level. So understand that we are small fish in a very, very large pond. So not only does incorporating make sense from limited liability purposes, from tax purposes, but also, and you're not going to find this online, but statistically speaking, with numbers that we've put together here at Robert Hall over the past 50 years of being in business, incorporating also reduces your risk for audit by upwards of 90+%. So once again, you're a very small fish in a very large pond. In fact, actually, I think that you can actually pull up these stats online now. I think it's 1 in every 350 incorporated entities has a risk for being audited. 1 in 35 sole proprietors, Schedule C sole proprietors, has a risk for being audited. Still pretty good odds. But 1 in 35 versus 1 in 350, I'll take the 1 in 350 any day of the week. So let's assume, just for numbers' sake and ease for calculation, let's say that you had a good year, you generated $200,000 of income. You went out throughout the year, you bought $100,000 in equipment. Now you've got $100,000 of leftover profit in your business. On $100,000 as a sole proprietor or an LLC, remember LLCs, no tax benefit, right? So sole proprietors and LLCs, they'll pay the same type of tax, same level of tax. So on 100 grand, look at average federal tax rate, 25%, average state of California income tax rate, 9.3%. And then you get hit with this nasty self-employment tax. See, as self-employed individuals, we're required at the end of every year to pay our fair share of not only federal and state income tax, but also to contribute to Social Security and Medicare, right? W-2s, they have it taken out every month, every paycheck. But you as a self-employed individual, you have to pay it all. You have to pay the employer portion and the employee portion because you're both. You're your own boss, right? You're self-employed. And so that alone is 15.3% of your projected profit. I'm using very rough calculations here, but it's just to kind of explain how this all breaks down. In the left-hand column, you're probably thinking, well, Tony, why the heck am I working so hard? Look at all of that money. I'm just not flushing down the drain. It's going somewhere, but it's not going back into your bank account, right? So you're thinking, well, there's got to be something else. Aside from the planning of buying new, used equipment, going out and buying a company vehicle, paying myself rent out of a business, after all of these things are taken into account, I'm still paying all of this tax. There's got to be something more. Well, remember at 45 to $50,000 in net revenue, if you're making $100,000 in net revenue, way above that threshold, that 45, 50 grand, if you flipped yourself to an S corporation, look at on the right-hand column here, okay? If you flipped yourself to an S corporation, it's a much different story because now you are no longer self-employed, are you? You are actually an employee of your own corporation, and employees receive not 1099s, they receive W-2s. So this is where the magic happens, okay? The S corporation is kind of the unicorn of the tax industry. And as you can tell, I get excited about it because I have several S corporations. A lot of my clients have S corporations, and it's because the S corp actually been around since 1972, 74. Don't hold me to that. Been around since the early 70s. So it's been around for a long time. And so people have been able to fine tune it over the past 30, 40 years. The S corporation plays a game called the reasonable salary requirement game. And that requires you actually to put yourself on payroll because you're no longer self-employed. You're employed by your own corporation. And this is once again where the magic happens. You actually have to pay yourself a minimum salary of 40% of your company's net profit. Well, in this case, 100 grand, easy to calculate off of. 40% is 40,000 bucks. So you've got a $40,000 W-2. You've got $60,000 in leftover profit because you get to write yourself off, right? So now that you have these two numbers, doesn't matter how you spin it. When you add them back up, it's 100 grand, right? So federal and state income tax don't change because you pay tax, federal and state income tax on the full 100 grand. But look what happens to your Social Security and Medicare tax alone on 100 grand. This is just by incorporating. This is not like waving a magic wand over your business and all of a sudden deductions fall from the sky. That's not how this works. This is simply restructuring your business to take advantage of the advantages that corporate America gets to take on a year-to-year basis, right? And these business owners did not write the tax code. So this is something that the IRS put in place to help business owners retain profit. Okay. So now you've dropped $15,300 in Social Security Medicare down to $6,120. That alone is a total tax savings right out the gate of about $9,100. Let's cut your profit in half. Let's drop it down to that $45,000, $50,000 threshold. Even at 45, 50 grand, it's saving you about $4,500 in overall tax. So once again, we have to make this calculation. Does it make sense from a liability standpoint? Does it make sense from a financial standpoint? And then is it going to save me more than it's costing me? Well, what are the costs, right? Here in California, we've got an $800 parking ticket. I call it a parking ticket because it's an $800 fee to park your business in this wonderful state of California. And so that's $800 plus $25 to the Secretary of State. So $825. Now that you are incorporated and an employee of your business, you have to run payroll, which averages about $700-800 a year. So you're at $1,600 roughly. And then you've got to pay an accountant to file the return, which depending on who you use, if you come to us, our average rate for a corporation is about $800, could be more depending on the revenue and depreciation schedules, assets, so on and so forth. But let's just say at the high end, $2,500 to file as a corporation. It's still saving you almost double what it's costing you, even at 45 to 50 grand in income. And you're receiving the much lower risk for overall audit, and you're allowing yourself to have greater asset protection. It's a no-brainer at that point. But these are not numbers that you should be navigating yourself, right? These are numbers that you should be sitting down and having this conversation every single year with your tax advisor. Is now the right time? My numbers are X, my expenses are Z. Like where am I at right now? How far am I off from incorporating? Or if you've acquired a lot of assets, maybe it's time for us to incorporate to protect assets. And in this case, and once again, I hope your eyes aren't rolling back in the back of your head, but it actually gets more creative. The structuring benefit gets more creative the more you acquire and the more money you make. So naturally, when you start to acquire hundreds of thousands of dollars in equipment, let's say you buy a building and build out a recording studio, and then you have your business, TW Sound Mixer Professionals, Inc., right? Tony Watson Sound Professionals, Inc., or whatever. I might want to put all of my sound recording equipment in an LLC. I bought a building, so I want to put the building in its own LLC. And then I have my TW Sound Professional Inc. Corporation as an S corporation. So now that I have three entities, why would I want to do that? Well, now my S corporation, my LLC with the equipment, and my LLC with the building, they all have separate liability protection. On top of that, my S corporation can pay rent to my LLC that owns the equipment to rent back or to lease the equipment from my LLC. I can also pay myself rent into the LLC that owns the building that I operate out of now. So now money is flowing back and forth, allowing you for greater asset protection, asset separation benefit. And every dollar that you convert from self-employed corporation income into rent, guess what? Avoids paying self-employment tax. See, when you start to convert self-employed income into other types of revenue like rental income, and in this case, you're just renting back your own assets to your corporation, completely legit. This is all built into the Internal Revenue Code. This, every dollar that you're paying in rent to rent equipment or rent the building, that is avoiding paying 15.3% of Social Security and Medicare. So you're further reducing your corporate income, corporate profit, and at that point, you're paying overall less in federal and state income tax, and you are paying yourself less on paper. Even though all of the money is yours, you're paying yourself less on a W-2, which means that you're also reducing your own individual Social Security and Medicare tax. So when you're making $300,000, $400,000, $500,000, I mean, we're not talking about a couple $100 in tax savings here, right? Everybody gets that. We're talking about tens of thousands of dollars in tax savings solely by structuring your business in a very specific way. Yeah, Thomas.
No, I'm just listening to you. Everything sounds great. There is one question from someone, but I don't know if it's a great time to ask. He says, if I'm receiving box rental rates untaxed, do I pay taxes on those rentals during the tax season? You know, I think that obviously we purchase a lot of gear, but we also rent things that we give back after we're done renting them. How does that play into the taxes and how this all works?
So you give back when you're so this is not you owning the equipment and renting it out. This is you renting someone else's equipment.
Yeah, for example, let's say I'm working on a job and we're going to record some underwater experience. You know, we literally have underwater microphones in the world. So if you guys needed to, you could rent from any one of our 5 locations at True Audio an underwater microphone. There's a bunch of different kinds. Use it on your job and then bring it back, because that's not the type of microphone that you're going to go out and purchase for that one job that you get called in your lifetime. Like I've had one underwater job that I used it for, where, you know, it's not necessarily something you want to purchase. You'll just rent it instead for that one job, and then you give it back.
So in this instance, remember that when you rent this equipment, that is an expense for your business. You don't own the asset, right? So you have to give it back, but the rental expense that you pay is going to be a dollar for dollar tax write-off against any income that you generate from this underwater gig in this example, right? So if the underwater gig pays you $10,000, you have $3,000 in rental equipment, then you deduct $3,000 off the $10,000, you only pay tax on $7,000. Okay. Now, some of my clients actually will also have companies like True Audio that they'll work with where they'll rent the equipment, and then I don't know if this is legal in your industry. I'm assuming that it's not illegal, but I don't know, maybe it's frowned upon, where they find a good rental expense, they bring it to their own studio or their own, you know, job site, and then they bill a higher rental expense to the people paying them. This happens a lot with wedding photographers, actually, where they'll go and they'll rent camera equipment and sound equipment and all of these other videography equipment, but then they'll upcharge the person having the wedding, right? So it's common in a lot of industries. And in that case, the rental expense, you say you pay $3,000 to rent the equipment, that's a $3,000 expense to you. But if you're generating $5,000 in income off of it, $5,000 comes in, $3,000 goes out. So you only pay $2,000 on that particular job. So there are a number of ways how numbers can flow that way. All very common scenarios in the entertainment world, whether it be music, producing, so on and so forth. Those are common scenarios. Hopefully Was that the question? I hope it was.
You know, he actually responded back. He said, for me specifically, it would be the production company renting my gear from me as a sole proprietor. Yeah. So he's not a corporation right now. Mm-hmm.
Right. So box rents at the moment are just rental income, which is great. So unless you are doing that full time, meaning that if you went out and bought $100,000 of equipment and people were paying you rent, the government actually wants. And they haven't passed final legislation on this, but I'll tell you why it might make sense to do it this way anyway, and just to head it off at the pass. The government wants active business rental income in this instance to be considered self-employed income. And I don't necessarily agree with that, because rental income should be rental income, self-employed income should be self-employed income. So if you're only renting out, $5, $10,000 of gear per year, keep it as rental income, because rental income does not pay self-employment tax, right? So right out the gate, you're already saving 15.3% by keeping it as box rental income. If you convert it into self-employed income, let's say you're making 100, 200, 300 grand in box rental income or studio rental income, you may want to actually put that in as self-employed income tax or self-employed income, because at that point we can start deferred comp plans. We can acquire other business assets like vehicles for active participation business elections and business situations. So when you hit a certain level of income, and depending on how actively you participate in this type of business venture, it may actually be worth it tax-wise to flip you over to a self-employed business that actually collects rental income and is taxed at a self-employed tax rate. But once again, very unique situations would call for that. That is absolutely a conversation you'd have with a tax professional. Okay. So now I did want to talk about some top tax deductions just for business owners in general, because we have the equipment rentals, the equipment purchases and things, and that's definitely part of the top 5. But I just wanted to mention, I'm going to skip through a lot of these just so we get the top 5 up on the screen, so I can go one by one.
You know, Tony, actually, to let you know, I think your screen isn't sharing. I'm showing the slide on my end, but if you could turn off your screen sharing and turn it back on, or just flip to your face, because I'm not seeing your screen move. Now I can see you. If you don't mind leaving it like that, I'll just follow along and they can see your face for all. We haven't seen your beautiful face in a while.
And I didn't see the green light on my camera, and I'm thinking, well, maybe this is a unique, this rendezvous program. Maybe it knows something that I don't. So I'm glad you told me that, because I definitely want you to see how excited I get on these topics, because I'm very, this is something that we're all passionate about here at Robert Hall. Otherwise we wouldn't be tax professionals. But this is something that we practice what we preach, right? We implement a lot of these strategies on our own tax returns. I mean, why would we not, right? I'm telling you how much money it's saving you. Why would we not want to do this for ourselves as well? So, I think that up in front of you, because I don't think I can see your screen. There's a top 5 tax deduction screen where if you can click through, I think 10 times, it'll give you all 5 topics on that screen. And so number 1 is going to be marketing and advertising. Number 1 expense for business. If you are in planning to grow your business, you have to market and advertise yourself. So that's going to be a dollar for dollar write-off right out the gate. Number 2, professional supplies and equipment. This is the one where sound recorders and other like-kind professionals, they really need to hone in and focus on from a tax deduction benefit standpoint. Number 1, equipment has one of the lowest risks for audit. The government understands that there isn't a single person in today's day and age who can do what they do professionally without a cell phone, without a computer, without monitors, without Wi-Fi, networking equipment, without sound equipment in your industry, specifically without the microphones and the boom stands and the lighting fixtures and everything that you're buying for your own studio. So one of the lowest risks for audit is all of the equipment that you're buying. So make sure that you are maximizing that angle and taking what's called the Section 179 election on all of your equipment purchases, fully allowing the deduction to flow through on your business return. I did want to make a side note really quick that is a great federal election to make, meaning that you go out and you buy $100,000 in overall recording equipment. The government is going to allow you a dollar for dollar deduction against self-employed income for the equipment purchase, whether you finance it or buy it outright. But the state of California has not conformed to that part of the Internal Revenue Code. So let's say you made $100,000 and you spent $100,000 on recording equipment. Federally speaking, you have no profit. But on the state side, the state is still going to tax you on $100,000 because California has not conformed to that part of the Internal Revenue Code. So just be aware of that. That's a very unique part of the state versus the federal tax code. Number 3 is going to be car and truck expenses. Obviously, any mileage that you put on your vehicle, if you go out and you purchase a vehicle, it kind of works similar to the equipment purchases that you're making. When you go out and you purchase a large vehicle like a Sprinter van or a Chevy Tahoe or Silverado, Escalade, these vehicles that weigh over 6,000 pounds, they also qualify for bonus depreciation like your recording equipment does, meaning that a 6,000 pound or heavier vehicle, 100% tax deductible. So make sure that you have this conversation with your tax advisor about how to maximize this deduction. Number 4, legal and professional fees, dollar for dollar deducted against your self-employed income. And last but not least, the in-home office. I had 6 clients who are sound recording professionals build in-home studios in 2020. We're talking about anywhere from $100,000 in overall build out to $500,000, $600,000 in build out in some of these Hollywood Hills homes, converting full-blown garages into recording studios. Can't imagine their neighbors unless it's all soundproof, right? Neighbors probably are driven crazy, but more likely than not, with a $500,000 improvement, you got it soundproofed and everything like that. The government expects your industry to have this type of expense, especially in 2021. In 2020, but filing in 2021, because we were all forced to work from home. A lot of people weren't going into the studio. Maybe some of you still were. I was still coming to my office for the most part, but our office was shut down to the general public. We weren't meeting with people face to face just because of COVID. We still aren't. which is crazy. And we've been shut down since first week of last March. And until LA gets up into that, what was it, the purple, magenta color code or whatever it is, then we open back up for in-person meetings. But for the time being, we've all worked from home. So I did a home office build out. My wife built out her home office. I'm sure that you built out the in-home studio. These are great dollar for dollar write-offs for self-employed income. Now, if you are not incorporated, the deduction changes a little bit. So depending on if you're a sole proprietor versus a corporate entity, the in-home office deduction does change. So I want to make sure that everybody understands that if we go to the next slide, I don't know if you can, well, you can't see my screen, I don't think. Can you go back one slide? I think it's the home office expense.
This one right here, the $100,000 profit.
And I don't. Nope. Well, no, I'm sorry. Go. Sorry, go forward. And it should say home offices right after the marketing slide. There should be a home offices up.
I'm sorry. The only one that I see is this one.
That's it, yeah.
Okay. Apologies.
I think once again, I think there's a little bit of delay on mine, and I apologize. We've got 45 people working in tax season right now, so our internet probably is being bogged down. But but the in-home office deduction is very unique. This is probably one of the hottest questions that's coming into our office right now via phone, via email is, hey, is the government going to allow for a larger deduction for home office? Does it have a lower risk for audit? Who is able to take advantage of the home office deductions? The craziest thing about this is that even though people were forced to work from home, teachers were supposed to Zoom FaceTime their children from home. Children were supposed to learn from home in their living rooms. Parents were expected to work and teach their kids school for months on end. So it was a very unique year overall. The federal government has not moved to change the in-home office deduction for W-2 wage earners, like the teachers, the firefighters, the police officers, the accountants. Because we're W-2'd, we are not able to write off an in-home office deduction on the federal return. California will allow a little bit of it. California's is a small benefit, though. IRS has not changed that. So once again, it brings me back to the point that you as a self-employed individual, you have a unique opportunity to maximize a deduction that not everybody gets. So if you did build out a studio in your garage, that square footage and the closest bathroom can be included in that square footage. This could be a very large tax shelter for your self-employed income. So be aware of that. If you are self-employed, you file a form called an 8829 form. The 8829 form prior to the pandemic has roughly about a 75 to 80% chance for audit. Everybody knows the in-home office deduction is one of the highest audited write-offs. Questions coming into our office, hey, is there going to be less of a risk for audit? Not for W-2 wage earners. Unfortunately, the in-home office deduction, it's not audited because it's not a legit write-off. It's audited because people aren't reasonable with the square footage allocation. So for the self-employed individual, the government expects you to have it. But for W-2 wage earners like myself, if I were ever audited, I'd have to go to Bob Hall, which I could. I mean, I've known Bob Hall for 17 years. We've done business together. Obviously, he allows me to teach taxes to all of our clients and potential clients. So I'm close with him. But I would actually have to get a letter from Bob Hall, signed by Bob Hall, stating that I am required to work from home in order for me to even put that on a return that the government doesn't even allow as a write-off. So once again, it's a catch-22 for W-2 wage earners, but for self-employed individuals, you're the business owner. You can work from anywhere, right? So make sure that you're maximizing that benefit. That's for the sole proprietor. If you are incorporated, different story. You don't file this highly audited 8829 form anymore. You actually pay yourself rent out of the corporation and you file a rental property form on your individual return. That's if you own the home. So once again, I don't want to get too much off track, but this is a very unique opportunity for you to maximize a benefit that not everyone is able to maximize, okay? Next slide, I did want to touch on something that's really near and dear to my heart coming out of 2018. It's something called the QBI deduction. Okay. Now, what is QBI? It's qualified business income. So if you go to the next slide, Thomas, perfect. This one, and it should show a flow chart. My screen's kind of freezing right now, but it should show the QBI deduction flow chart. And Thomas, can you see the yes and the no columns on the left and right? I can,
yes.
Perfect. So this is something really unique and only an opportunity for active management self-employed individuals, meaning that if you actively participate in your business, which I'm assuming all of you do, that you would qualify for something called the QBI deduction. This has been around for 19, so for 2 years now. Okay. 2020 is the third year that it's been around. And this essentially states that if your income is below one of these very important thresholds, and in this case, it would be for single individuals, 163,000 taxable income. So after all of your deductions are taken into account, for married filing joint, $326,600. If your taxable income is below this threshold, the first 20% of your business profit is tax-free. We love that phrase, right? Tax-free. So imagine if you and your spouse are working as self-employed individuals. Let's say your spouse is a realtor, you're the sound recording engineer, and let's say both of your businesses, I don't know, just throw out a number. Let's say they both net $150,000. So add it together, that's $300,000 of qualified business income. If because you're under the $326,600 threshold, if your accountant knows about this election on the return, it doesn't automatically assume anything about your business. This makes what's 20% of $300,000? That's $60,000 of income you pay no federal income tax on. So once again, I want you to make sure, if you can go back and you have access to your 18, 19, and 20 returns, make sure that you qualified for the QBI deduction if your income is below this threshold. If your income is above this threshold, married filing joint or filing single, you might start to phase out from this benefit. But once again, even if you're phasing out, that's even more important for you to go out and reinvest money back into your business to drop you back into a lower income bracket. Remember, reinvesting back into your business, right? Reinvesting back in infrastructure, buying new equipment, saving yourself tax, and now qualifying for this massive 20% QBI deduction. There were three things in my very first Business 101 course in college that basically has stuck with me my whole career. My Business 101 teacher, really super cool guy, Tommy Bahama shirt, drove a really nice Porsche 911, made a lot of money earlier in his life, but decided that teaching was his passion. So I listened intently in his class every single day because I thought, man, this guy is the quintessential business guy. And in retirement, he wanted to educate people. He said 3 rules in business. Number 1, pay your employees, always. If you have employees working for you, pay them, because they will do great things for you if you compensate them. And let's face it, if you hire them, they should get paid for the job, a job well done at least. So number 1, pay your employees. Number 2, reinvest profits back into infrastructure. He said it a little differently, but you get it. You take your profit, you reinvest it back into yourself, back into your business. And he said, rule number 3 is the most important. He said, pay as little tax as possible by exercising rule number 2. Now, in my Business 101 course, as you know what, I think it was 18, 19 years old. I was a DJ at the time, if you can imagine, an accountant as a DJ in a past life. I loved music. I've always loved music. I've been playing the piano since I was 4 years old, play a couple other instruments as well. Music is a big part of my family, my wife's, and it will be part of my son and my daughter's lives as they grow older. I found that as a business owner, that really rung out for me because at 17, 18 years old, I had to file my own self-employed tax returns. And I didn't realize what all of this tax was, right? I didn't get it because I wasn't apprised of all of that information just yet. But that has stuck with me for a long time, especially when I talk with my clients about what they can do to pay less tax, what they can do to retain wealth, to build business, and pay less tax. And that says it all. If you take your profit and you reinvest it back into your business, into things that will make you more money, the government will actually allow you to pay less tax by reinvesting into yourself, by reinvesting your money and your profits back into your own business. And that is a great way to reduce income and qualify for a lot of these really, really beneficial business credits. So once again, the wealthy just keep getting more wealthy, right? Business owners can retain more wealth. And I'm not here to say that this is wrong. I'm here to say that in the US economy, what stimulates job growth? It's creativity. It's independent work. It's people starting businesses and growing it to a certain point where you physically can't handle all of the work, so you are forced to hire more individuals. The government knows this. They've always known this. And so they know that as a W-2 wage earner, a teacher who's incredibly important. Both my parents were teachers and real estate investors. So I'm very, very, appreciative of everything that teachers do. But just from a base teaching standpoint, they're not creating jobs at the moment, right? Maybe college professors are because they're stimulating the minds of young, business individuals in their, a little bit later age. But in high school and in middle school, teachers aren't stimulating jobs. So a lot of those deductions aren't meant for them, right? The business deductions are meant for you, self-employed individuals, because you hire contractors, you pay businesses for hundreds of thousands of dollars in equipment, and the government wants to give the tax benefits, the tax breaks to you. and really not anybody else, just the self-employed realm. So keep that in mind. It is incredibly important to do year-end planning ahead of time, right? So plan ahead to pay less tax. Failure to plan is ultimately planning to fail. And so in the fourth quarter of every year, sit down, map out your year-to-date income and expenses, and go to your accountant, to us or to whoever you use, and make sure that you sit down and map out a plan. Say, hey, this is how much I've made so far. This is how much I've spent. This is my taxable income. Your accountant cranks the numbers, right? We add it up in our little computer system, and we tell you how much tax you'd pay if you just cut off the year right there. And you say, oh my God, that's a lot of money. I made good money, but I don't want to pay that much tax. Okay, X, Y, and Z need to happen before December 31st for you to retain most of your wealth. Maxing out deferred comp, purchasing new equipment, purchasing a vehicle, prepaying for travel, buying a property and allowing depreciation. I mean, there are a number of tools that you can use, but you have to plan ahead. All right. More importantly than ever, you have to plan ahead. So I think I've hammered that enough. Thomas, that was the last part of the business slides. If we go to the next slide, I think that it's just a breakdown of essentially what we offer at Robert Hall. Like I said, we've been around for 50 years, so it's more than just tax preparation that we do here under our one roof in Glendale, California. We do tax preparation. That's our main service. So I do only tax preparation. I have a bookkeeper on the first floor, Farshid Khosravi with CAA Accounting. He's insane at bookkeeping. We've got payroll services. We've got accounting services. We incorporate people. It's like a one-stop shop, and that's what Bob dreamed about 50 years ago when he wanted to build this business. And perfect example, he is the perfect example of what reinvesting in yourself, reinvesting your profit back into your business. He's a perfect example of what will happen if you do that, and if you're religious with that kind of plan. 50 years ago, if you asked him, I don't know if he'd tell you the truth, but if he was not a very wealthy person, ever in his life, and it's a true. I don't want to call it a rags to riches story, but I believe that at one point he didn't have a place to live. He was actually living in his car for a little bit of time. Once again, I don't know all the details. I've known Bob Hall for a long time, but this is a true inspirational story of a man who found a career that he loved, that he was passionate about, that he was able to create jobs with, and also learn a very unique trade. And he built it into an empire. We service 15,000 tax filings across the U.S. with only one location, and 14 senior accountants with 45 people on staff here. So your business can very much be that prosperous. A big part of your wealth growth or wealth retention will be proper tax planning. I cannot stress that enough. So obviously I've talked about a lot today. I'm sure that there are some specific questions, Thomas, that we have time to go over. But if this is not the right venue to dive into more of your detailed questions, I did want to mention again that we do offer free consultations for everyone who feels like they're just not getting the proper advice. And that's really what we're good at doing. We're not an educational firm, even though we do webinars and seminars and things. That's more just for free educational purposes. We're not going to bring you in and teach you how to prepare your own tax return. We're going to do all of the work for you. But we absolutely want to show you what we're doing to save you all of this money. And what I like to do normally is I have 3 screens on my desk, and same with the other preparers. We'll prepare the return. We'll kind of show you what it's like if we just went straight off of straight out the gate deductions and things that you've put together, and then we show you the different scenarios that we can put together and map out for you for future planning. And it'll absolutely blow your mind, especially because you're self-employed, as to how much tax you've been paying in past years or leaving money on the table, and how much moving forward we can actually retain as part of your wealth growth plan.
I completely agree with that. The reason why I selected you guys is, you've made a stressful situation for a lot of, independent contractors or people that have, beginning corporations. You make it a lot less daunting, and you're very transparent about it. It's not like, hey, what are you doing? Can I look? No. And you turn the monitor away and don't look. I'll tell you when I'm done. No, it's very back and forth. And, Minju, my tax advisor, she's always been helpful. I think what I would love to do is I want to finish by telling everybody that you have incredible help. If they want to get help from you, you have a free advising special for them. Is that right?
That's correct. 30 minutes normally in person. So we wish that we could be open and seeing all your smiling faces in person. We're just not at that point yet, because normally during tax season, we see 120 to 130 people, warm bodies, I call them, in our office every day, Monday through Saturday during tax season. LA was not willing to lift the ban on our type of service industry, especially with the amount of clients that we see on a day-to-day basis during this time of year. So everything is being done digitally. We've we've absolutely created just an efficient process for uploading documents, for people dropping off documents to our office, and then we do either Zoom or we just do it by phone, however you want to connect with us. But that's for tax preparation. For the free consultation, we could Zoom, we could FaceTime, we could just talk to you over the phone. But this is really meant to break down what you've been doing in the past on your 2020, 2019, 2018 returns, and then looking forward into the future, how we can mold you into a Robert Hall client. And if you follow our advice, our little points, and it might not be that much that you have to change. We could change one thing in your overall business situation and create an incredible amount of efficiency that could end up saving you a lot of money. That we've seen it before. Otherwise, I wouldn't be mentioning it. We're definitely not in that industry to overpromise and underdeliver, right? Usually, the clients that we take in, they have done things correct. Their other preparers have done things correct, but there is just a lack of I don't want to say aggressiveness, but there's a lack of implementation on the parts of the tax code that truly are meant to benefit self-employed individuals.
How about the word finesse?
Finesse, there you go.
Finesse.
I like that.
I
like that
truly mean that. Like I have never felt more comfortable with my taxes than having Minju and you guys at the Bay. Let's end this live stream, Tony, by saying if people do take up this offer, which we have on the screen, by the way, all you need to do is text the word Robert Hall to the number 72,000. And when you guys get them on the phone, tell them that Thomas from True sent you. I think they'll love to know that. What do they need to do to be prepared for this phone call? What would the perfect, like you said, Robert Hall client do before they pick up the phone and call you?
I would absolutely suggest gathering copies of the most recently filed returns, 2 years preferably, just so we can see how you've structured yourself in the past. That kind of tells your story, right? We're good people. We're not reading verbiage on your return. We're reading numbers and figuring out what happened in your financial world over the past 2 years. Did you inherit money? Did you liquidate retirement assets? Did you sell stock? Did you start a business, close a business? This tells your financial story over the past 2 years. But on top of that, in order to maximize this 30 minutes, and once again, some of you might be thinking, well, what can you do in 30 minutes? Test us. Try us. I absolutely think that your mind will be blown as to what we can cover in that 30-minute conversation. And also, once again, aside from the copies of the tax returns, take a couple minutes to jot down some questions, or maybe even over a couple days. Always think, okay, well, my appointment's next Wednesday, my free consult's next Wednesday, and let's say it's the Wednesday before. Over the weekend or over the couple days beforehand, jot down questions that you have. It can be anything. It could be aggressive questions. It could be the borderline illegal questions that you think, well, maybe I could get away with this, maybe not. Ask us those questions, because sometimes the general public, and I don't say general public in a bad way, I'm just saying people who aren't tax professionals, they don't understand what their rights are. They don't understand what deductions they're able to take. They don't understand the way that they can structure themselves, because it just isn't general knowledge, right? The tax code is written by brilliant people. I think some of the most brilliant narcissistic people in the world, actually, but it is incredibly complicated. And so if you are entering into a storm and you're not a professional or a weathered boater, right? Or the term escapes me, but a person who understands how to navigate the sea, you're probably going to fail at navigating the rough waters, right? That's what we're here to do. We're here to not smooth the water. We can't just make things disappear into thin air. We're here to give you the tools to navigate around that storm.
Exactly.
That's probably once again, that's my last phrase.
Yeah,
that's my last.
The most important thing that I can tell you is communication with your tax advisor. If you're going to be that person that just says, "Oh my God, taxes are due tomorrow," like you wake up, you're like, "What?" Like that's not a very healthy way. If you want to take yourself professional, it doesn't matter how good you can do your job on set. You have to make sure that you're well-rounded, and that's what we're trying to do here at True Audio, is make sure that your accounting and your finances and your taxes are well-rounded too. So it's not any given month that I'm not emailing Minju to be like, "Hey, what about this?" So you want to just they're your clients. You want to have that dialogue with your tax advisor and have them be part of your family. The more of the family that you let them in, the more they're going to be able to help you.
Yep.
Amen.
Very much so. Couldn't have said it better myself.
Love it. Everyone, again, free consultation. Text the word Robert Hall to the number 72,000. You'll be able to talk to Tony and some of his advisors here. Make sure you let them know that Thomas from True Audio sent you. And guys, I highly recommend taking them up on this. Even if you decide not to go with their services, at least you might be able to get some advice and just have a good, healthy dialogue about your taxes. So, Tony, thank you again so much for this tax prep seminar. I appreciate it.
Thanks, Thomas, for having me. Really appreciate it. And thanks, everyone, for attending. And once again, utilize our services for whatever you see fit. We're here to help.
Excellent. Everyone, thank you so much. We'll see you next week on another True Audio Presents. See you soon. Take care.